Welcome to Wednesday webinar. Today's session will be mastering solutions for diverse credit and ATO tax debt, sorry. So as we all know, from the 1st of July, clients can no longer claim ATO interest charges, which has been a critical change that can impact borrowing capacity and credit strategies. So today we're joined from Pepper Money. We have Samantha Hansen, the National Manager for Sales and Broker Support, who's been around for a long time, very experienced, and a experienced visionary leader managing high functioning teams, as well as Taylor Veld, who is the mortgage credit team leader, has been with Pepper for 8 years, who also is very experienced. Now, without further ado, I'd like to hand over to Samantha and Taylor. So guys, thanks for joining us. I will hand over to you, but before we kick on, I also just want to tell our guests that we do have a chat function live today. So any questions that may pop up during the presentation, please place them in there, and Samantha and Taylor will do their best to answer them at the conclusion of their presentation.
Wonderful. Thank you for such a lovely introduction, Steve. Although I haven't been around for a very, very long time, I am still young, but I have been in the lending industry for quite a bit of time. No, I'm only joking. It's okay. Yeah, and thank you so much, Taylor, for joining me today. So Taylor's from Credit. Taylor and I educate all of our brokers here at Pepper Money on lots of different topics and subjects. So we're really excited to be here to present to you guys today. So we'll kick it off. I'm going to share my screen. So just give me 1 second and I'll get that happening. Hey, you can see that one, Steve?
Yeah, all good.
Wonderful. All right. So Pepper Money has been around for 25 years now, and it's pretty exciting to see the development that we've done in terms of product and policy innovation to continuously grow with your clients' needs. Now, when I started at Pepper 6 years ago, we only had a residential offering, and it was prime, near prime, and specialist. Since then, in the last 6 years, we have expanded so much and so quickly to keep up with the demand for your clients, and we've expanded our policy and product offering into commercial, SMSF, and also construction. We also now have a full doc and an alt doc offering across all of these product offerings as well. So it's really exciting how quickly we're developing, and we understand the need that you guys have out there in market to be able to provide all those different solutions to your clients. So I'm really excited to see what we come up with in the next 5 years. In terms of the Pepper Money world, it goes without saying that non-banks have a more diverse solution and offering than the major banks. So in terms of bank, you're typically looking at clients that can provide somewhat of a prime solution, clean credits, strong credit scores, standard income types. But when you come into the non-bank world, and Pepper Money specifically, as I've just demonstrated, we have so many different solutions across so many different product offerings. And we do cater to clients that have or may be impacted by a real life event. So we have got a cascading credit model that provides solutions to a client at any stage of their life. And a saying that we use quite frequently here at Pepper is that prime is just a moment in time. So everything might be going fabulous for a short amount of time, and then something could happen personally that prevents you from going to work, or something terrible might happen. And unfortunately, we're not all perfect, and we can't keep up with everything all the time, and sometimes our debts get mismanaged as a result of that, and therefore Pepper Money has lots of solutions that can cater to providing solutions to those clients who may have an impacted credit report. So ATO, this is a hot topic.
Really?
So if you can believe it, there is over $50 billion in outstanding tax debt collectively around Australia at the moment. So there's a huge need to be able to fund and pay out that debt. And 65% of all collectible debt owed relates to small businesses. And over 62% of consumers out there sit in that self-employed space. So there's a huge opportunity for you as brokers to be able to provide solutions to these customers. Now, when we're looking at debt consolidation, and unlimited cash out, refinance, ATO tax debts, and being able to provide a better solution for your clients, I want to throw it over to Taylor because he's our credit expert. Taylor, can you please define our requirements for verification to support clients with cash out? Like, we can obviously do unlimited cash out, which is amazing. But can you talk to me around what are the supporting documents required, if any?
Yeah, I mean, in general, we do unlimited cash out. It's just to the stated purpose and does it fit the customer's profile. So a customer with, 5 investment properties that wants $1 million cash out to buy another property, that fits their profile. That's what we're looking for. So as long as it makes sense, we're comfortable with their profile and we get a breakdown of what the cash out's for. That's what we're looking for.
And what about if we're looking at somebody who is looking for business purpose cash out? Because we do offer business purposes as well as personal. So could you give me a scenario where the business purpose fits the client's profile? Yeah,
so again, they might be running a business that's looking to expand a bit and they want a few $100,000 to buy some extra trucks or to buy a warehouse, something like that. We can facilitate that in our cash out policy as well. Just when it's business cash out, we don't do it on Prime, so it has to go on one of our other products.
Okay, perfect. And what happens if it doesn't suit the borrower's profile? And say, for example, you've got a client who wants to go purchase a property outright, but maybe they've only got an owner-occupied property and they're looking to utilize some of that equity as a deposit. And they're looking to just go and purchase that property. What are the requirements there?
Well, I mean, again, depending on their profile itself, we may assess an entire application and just have the final condition saying a contract of sale for that property. That's one option. It'll just come down to what their profile looks like. But again, if they're clean credit, long-term employment, we're happy and comfortable with it. We may still look at it just depending on the amount of that cash out.
Okay. One more question off the back of that one. So what happens if, say, for example, they're looking to purchase a property. They don't want to provide verification to support the purchase. They haven't got a property investment portfolio, but say, for example, they've got $2 million in shares. How do we treat that situation?
Again, to buy a property again? Well, again, it's sort of, they're quite asset strong. Again, if they're clean credit, their profile fits, depending on that level of cash out, look, we might be able to consider it. It's just the level of detail. They might even say we're looking at these types of properties and give examples of those properties. As long as we've got comfort around the purpose and we believe that's what it's for, then we should be okay.
Perfect. You'll see, guys, that I'm constantly trying to push the envelope with credit and try to get as much as we can out of them while we're capturing it and recording it. No, only joking. What I love about the credit team at Pepper is we're always looking at ways to do the deal. We always want to try and say yes, not say no. So it's great to have credit. And Taylor has been with us for quite a long time and he's a senior to give us the facts and to tell us how they would look at particular situations for you. On the ATO tax debt, so we have a couple of options. We have an option in our near prime clear product in residential, and we have an option in our near prime product in residential. Can you tell me the difference between the two solutions there? What are the differences between the two products?
So any tax that we can pay out under near prime clear, whether it's overdue, current, doesn't matter if the status, we can pay the debt out in full under near prime clear. If they've got it on a payment plan and they want to keep it on that payment plan, then it does fall down under our near prime product. We just factor that into servicing and it goes from there. So both options there, it just comes down to how the client wants to manage it themselves.
Okay, perfect. And with the tax debt, there's obviously been a lot of talk in market as well around the fact that the ATO is placing defaults on comprehensive credit reports under the individual because the tax debt is outstanding. We do have some policy parameters in both of the near prime clear and near prime products around defaults. Can you tell me what is our stance on defaults with tax debt specifically? Yeah,
so they've basically gotten to a point in the ATO and they've realised one way to make people pay these is to lodge these defaults. So normally that might push them further down our cascading model, but with the ATO debt specifically, If that's the only reason and everything else fits near prime clear, we can give an applicant a conditional approval subject to us paying out that ATO debt in full. They're able to take that to the ATO, say, hey, I've got an approval to pay this debt out in full. The ATO will remove that default. We can run a new credit report, show that it's gone, and then we can proceed on the near prime clear product or near prime as if it wasn't there. So there is that option for them.
Wonderful. So those defaults aren't an issue with us as long as we can get that confirmation that it will be removed. So we do also have options to pay out tax debt when using commercial security as well in the prime and the near prime product in commercial. We can't obviously refinance debt consolidation in the SMSF space, but you do have lots of options available to you in that residential and the commercial offering. In terms of refinancing business and private debt, what I love about Pepper, and this is to assist with providing a high borrowing capacity and obviously lower repayments and a lower rate, is that we actually don't provide interest rates based on the purpose of the debt. We provide rates based on the purpose of the security type. So if a client has an owner-occupied property that they would like to bring to us and they would like to refinance and pay out some business debts or private debts, we can actually give them owner-occ rates. So we won't apply different loadings. It'll sit in the correct product for that loan purpose type, but it will either be owner-occ rates or investment rates. So the rates are just dependent on the type of security. In terms of private debt, Taylor, can you just talk me through options for private debt? I know that we have a solution to refinance private debt in the residential space on our prime and our near prime clear and following products. Can you tell me the differences that a broker needs to consider when they're trying to consolidate private debt on prime?
Yes, on prime, I mean, if you can do private debt at all, they need to have met all their payments and agreements for that private debt. But we can consider it on prime if they've got demonstrable conduct on that debt. There is a lot of them may just be capitalised interest. Those are where we push it to near prime clear or below. But if it is a private debt and they've been making their payments of $5,000 a month or whatever it is, we can consolidate that on prime.
Perfect. So we just need to be able to evidence a repayment history.
Yep.
So it's basically, it can't be capitalised interest.
Yeah, correct.
If it is capitalised interest, we can assist on all of our other products. If they've got a repayment history, we can assist with private debt consolidation on our prime product, which would be welcome news to a client who is paying exuberant interest rates to then jump straight onto a prime rate, which is great news. In terms of unlimited debt consolidation. So obviously when we're looking at doing unlimited debt consolidation, we are looking to free up cash flow to assist with one repayment to manage easily and create more financial control for the client. We do have a 1% serviceability option for our prime and our near prime clear products. Now, the 1% serviceability buffer does have some policy requirements. So you are looking at a maximum LVR of 80% when utilising the 1% serviceability buffer. And then you're capped at maximum cash out of $20,000. But you can actually apply an unlimited amount of debt consolidation. You can increase the loan term and you can use an owner-occ or an investment. You can look at going from P&I to interest only. So it is an extremely flexible solution for clients who are looking to maximise their borrowing capacity, tie up all of those debts and get themselves into a better position to manage their finances. So the default serviceability buffer for us is just 2 as well, which is lower than your major banks, even to start with. And then you have that 1% servicing buffer option available under the prime and the near prime clear product. Now, we are going to go into greater detail on the near prime clear product policies and what we cater to in terms of adverse credit as well. So we'll touch on that shortly. So you can see just how diverse that near prime clear product is, which sits under the residential product offering. So if there are late repayments on debts to be consolidated, we can still look to consolidate those. And there's no issues because we do have that cascading credit model for all of our product offerings, whether it's residential, commercial. We don't do the debt consolidation piece for SMSF, but we still do have a cascading credit model that's available across all of our offerings. So if you've got a client who has a commercial security or they have a residential security and they are looking to consolidate multiple debts to create an easier position and better cash flow, then we do still have solutions for clients who may have late repayments and arrears or defaults and all that kind of stuff. And we are definitely going to go through that shortly as well. Wow, 40-year loan terms.
Yes.
So when I first came over from NAB, I was at NAB for a very long time, and I came over and I saw that we had a 40-year loan term. I was like, no, surely not. So it is really exciting. We've recently introduced a 40-year loan term across all of our residential products. So prime, near prime clear, near prime, specialist and specialist plus. But I do want to throw over to Taylor. Can you please give us everything we need to know about that 40-year loan term in terms of policy restrictions, exit strategies, loan structures, all of that type of stuff?
Yes, I mean, with the owner-occupied properties in general, we'll try and cap someone's age to 85, subject to there being a good exit strategy. Requirements around the exit strategy, if they're 50 years or older and it's an owner-occupied property, that's when we're going to need an exit strategy. That's if our loan term's at that normal 30 years. If we are going above the 30-year term, up to 40 years, if they're aged 40 or above, that's when we're going to need an exit strategy. For investment securities, there's not as much of the age restriction. Again, just coming down to they've got the ability to sell the properties, so they can utilise that 40-year loan term for investment as well.
Is there anything specific that we need to know around loan structure as well? So P&I, interest only?
Yeah, so if we do go above the 30-year loan term, there's just no interest only available. That's just capped at a 30-year term.
Yep.
If they want interest only. So all up to 40, it's got to be P&I.
Up to 40 P&I. So lots of options to utilize that 40-year loan term, tying that in with the 1% serviceability buffer. I am going to take you through some other niches that will really assist in boosting that borrowing capacity as well, that tie in with that 40-year term and the 1% serviceability buffer, or even the 2% serviceability buffer, that will really assist your clients in maximising their opportunities to get a higher loan limit, and also reduce those overall repayments as well. Full doc and alt doc. So we do have, as I mentioned earlier, a full documentation option and an alternative documentation option across our entire product offering. Now, in terms of our residential product offering, we have prime, near prime clear, near prime, specialist and specialist plus. Now, I'm going to talk a whole lot of stuff to you at the moment. So if you want any clarity around what I'm going to talk about in terms of full doc and alt doc, you do have an opportunity at the end of this webinar to complete a survey. So I highly recommend completing the survey, because it'll give you the opportunity to put your hand up and for your BDM or your RM to get in contact with you from Pepper Money. And also if you've got any further training requests. So if you don't understand something that we're talking about today, you'll just need further training to get some clarity and understand it a bit better, please do put your hand up for that question, and somebody from Pepper will be able to reach out to you to give you that support that you need to be able to provide those solutions confidently to your clients. So in terms of full doc across the resi space, we have your traditional option, which is providing your tax returns and your NOAs and your ITRs and financials. So that's your normal major bank style verification. And then we also have an alternate option to verify full doc, and that is just by providing the financial statements. We'll go into the financial statements in a little bit more detail shortly, but they're your two options for full doc. And then in terms of alternative documentation, you have the option to provide a self-employed income declaration, which is what the client would fill out. And then you've got 3 supporting document options. So you can use an accountant's letter, or you can use BAS statements, or you can use business bank statements. Now, in terms of the residential offering, this is the only offering where we have short-term ABN options. So you have the near prime product, which caters to ABNs 12 months or less. And then you have the specialist product that caters for ABNs 6 months or less. Now, both of those short-term ABN options are for clear credit clients only. All of the other products that we offer across residential, commercial, and SMSF and construction are all 24-month ABN and 12 months GST is the requirement. In terms of our commercial full doc options, again, you have the standard or traditional full doc option and the financials option. Alt doc is the same with commercial as well. You've got your stock standard 3 supporting document types and the self deck. There's a 24-month ABN requirement and 12 months GST for any product in commercial. And then SMSF. So if you have a client who's looking to, who would need to use or rely upon their additional surplus income that is separate to the self-managed super fund. So for example, if the rental income does not sustain the liabilities within the SMSF and they need to rely upon additional income sources and they are self-employed, we can look to do an alt doc option for that client if they are self-employed. And their options for full doc and alt doc are similar to the traditional full doc option and the standard alt doc option. So you would need to provide tax returns, NOAs, ITRs, and financials for SMSF full doc. And if it's alt doc, it's the same. You've got your 3 supporting document options. You only need to choose one, plus that self-employed income declaration. Okay, in saying that, I would like you, Taylor, to give us the down low on financial statements. And the reason I'd like Taylor to highlight this is because you have a great opportunity to assist clients. If they haven't lodged their tax returns, we actually don't require them to lodge the tax returns if we get the financials and they're presented to us in the correct format, which really helps. Obviously, you've got everybody's just finished the most recent financial year. Accountants are busy. There may be clients out there who don't want to pay tax debt, so they've not lodged their tax returns. We can actually provide a full doc solution up to a 95% lend, including 5 years interest only for both owner-op and investors, by supplying us executed financial statements. So they don't have to get them lodged with the ATO. We don't need to see them after settlement. We just ignore it. We just get the financial statements. However, they need to be presented in a correct way that meets policy. So can you just talk us through that policy?
Yeah, I mean, you covered it pretty well there, but as long as these financials, they're executed by the accountant, we'll be able to see the accountant's details and it's a registered accountant. Then that's all we need. And the beauty is they don't need those. We're not going to condition for them to lodge the tax returns and give them to us later. Like you mentioned, we don't need that. We're willing to go just off the financials as long as we can verify that accountant.
Can you just give us some clarity around wages?
Yeah. So within those financials, it may note during those financials, it may have directors' wages listed there. If the applicant's the only director, then that makes sense, and we can use those as wages to our applicant. If there's multiple directors, it would need to theoretically note the name of our applicant just so we can confirm that it's them. But then we're happy to add back and use those wages as well.
Perfect. So we can add back the depreciation like a normal full doc. We can add back depreciation. We can add back directors' wages. So it mimics the exact way we verify full doc using tax returns. It's the same process for us. Can you talk us through, which is a fantastic option for servicing, can you talk us through the fact that we ignore company liabilities and how that plays into the financials as well?
Yeah, so we're just looking to service the applicant on their personal situation. So company liabilities, they can exclude those. And we're just theoretically using, because that will be factored in to their financials already. So the profit at the end, if our applicant's entitled to it, that's what we're using, and they're just servicing on their personal debts.
Perfect. So just to summarize that, even though we can see the liabilities, I know there's a lot of majority of lenders out there will double up on commitments. It'll be included in their expenses. And then a lot of lenders do ask them to include those liabilities in the assessment as well. So we don't need them included in the assessment. They are ignored as long as, I believe, the company's turning over a profit.
Yeah, correct.
We don't need to include those. So even though there is a spot on our serviceability calculator for company liabilities, you can leave that blank. Just leave it out. So that's obviously really assisting with building up that serviceability for them as well. Okay, lastly, on the AltDoc component, we do have a new process that is all digital for AltDoc. It's called AltDoc Express. And on our broker portal, we do have a link that gives you the information in terms of how to complete AltDoc digitally. And basically what it's doing is mitigating the need for us to make a call to the client to confirm their information on the self-employed income declaration, and also a call to the accountant if there's an accountant's letter provided. We don't need to call them either. So this new digital process removes those phone calls and speeds up your client's time to yes. So it's a new process that's really efficient and effective. So if you're not across it, you can, and if you need a bit more training in terms of how to understand it and what you need to do as a broker, you can ask for our assistance through the survey just by putting your hand up and saying you'd like a bit of training. Otherwise, you can navigate to the broker portal under documents and forms, go to AltDoc, and then there's a link there that gives you some information around that process. I know we're really loving the new process.
Yeah. Saving a lot of time.
Saves a lot of time for us as well. So we urge you to use it because it benefits both sides, with us being more efficient in our SLAs and for you guys getting a quicker approval, of course. Now, question for actually borrowing capacity. So in terms of borrowing capacity, I'm just sort of going to highlight all of the key things or niches that build up borrowing capacity at Pepper. So you have got, as I've already mentioned, the 1% serviceability buffer. We've got no notional rent at Pepper, as long as the client can provide a rent-free letter. So we don't need a stat dec, do we?
No.
No. So as long as the rent-free letter is signed and dated by the person that's providing the accommodation and it is free of charge, we can accept that as verification to support no notional rent. So that means you don't need to put in that nominal figure of $650 that most lenders require you to input. There's no credit scoring at Pepper, which really assists in being able to provide a client with a prime solution, which is going to decrease those interest rates. So it doesn't matter how many times that client or how many inquiries that client may have, for example, or what type of adverse credit's going on in that report. If it meets the prime product parameters, the credit score doesn't come into play with us. So they're getting a higher grade product based on their overall situation. We also have no debt to income ratio and ongoing debt. So say, for example, you've got a client who has other mortgages with other financial institutions. Within our calculator, you have the ability to put in the actual loan repayments. So if they've got an IO loan, an interest-only loan with another lender, you can put the interest-only loan repayment in our calculator. If they've still got a fixed loan, I don't know if anybody has a fixed loan these days still, but if they've still got a fixed loan on a really low repayment, you can put the low repayment in our calculator. So it's actual repayments. Now, the calculator does have a buffer of 25% built into it, but it is much better than converting those loans over to P&I over the remaining term. So it does really assist with increasing that borrowing capacity. Negative gearing. So we do have negative gearing add backs that are built into two fields within our serviceability calculator. The first is the investment property loan balance. Now, commonly that box is missed because brokers feel there's a double up in repayments that's going to be calculated. But what you need to do is just put in any existing investment property loan balances. And if the new debt that they're looking to get with Pepper is an investment loan, you consolidate that and you pop it into that box. And what happens is the calculator is formulated to add back 6%, I believe, negative gearing to that figure that's in that box. And then similarly to the investment property expenses, which is in the commitment section, there is add backs of 6% in there as well. So those two boxes, when they're completed, if there is investment debt, really do assist in lifting up that borrowing capacity. Just quickly, Taylor, when can a broker not include investment property debt in that negative gearing box? Or when should they not? Is there anything that we need to know in terms of policy where they can't allocate investment debt? So obviously I would assume if there's no rental.
If we're not using rent, so say for like a vacant land, then we don't apply the negative gearing. That's sort of the main situation, but otherwise we will be using that negative gearing.
If there's a property, say for example, there's a property that's not tenanted at the moment, and we can see within the liabilities that there is an investment debt and there's no correlating rental income.
Yeah, if we're not using the rent from it, then then we can look to exclude that as well.
If the property is going to be rented, what will we need?
So for properties that aren't tenanted, it sort of comes down to a background of why it might be, they just completed some minor renovations that's going in. If we're using the rental income from, say, an appraisal, then the corresponding negative gearing will get factored in as well.
Okay.
So it just comes down to finding a reason why isn't it tenanted at the moment, doesn't make sense, and then what's the situation moving forward.
Okay, perfect. So we've also got a really great policy for clients who have an investment with a non-spouse. So a third-party investment, essentially. So say, for example, I have an investment property with Taylor. We look at considering 100% of the liability, 100% of the income, and 100% of the negative gearing. Is there an instance, Taylor, where we don't look at that in that situation?
No, I think you've covered it pretty well. I think that's sort of what we're going to look to do. They've got it, they'll take 100% of the rent, 100% of the repayment, and factor it in that way.
Perfect. So really good. A lot of lenders out there obviously ask for the client in the servicing to have 100% of the liability and 50% of the rental income, whereas we take 100% of everything, which is an amazing policy and it really boosts up serviceability. Can you talk to us, Taylor, around spousal relationships with shared debt? How do we look at it?
So similar, if we've just got one applicant on there, if they can service as a couple and service the full debts, that's ideal. Or we can go down the route of a common debt reducer, where we get evidence that the other partner has their own income. That way, then we can look to halve, theoretically, if they've got an owner-occupied property, we can halve that amount because we know the other partner is covering their half.
Okay. So there's two options there that Taylor mentioned when you've got a spousal relationship with joint debts. And say, for example, the husband might have an investment property on his own. The only time you can have two on loan and one on title is a spouse or de facto relationship. So if they're happy to come onto the loan, they can obviously assist with that servicing component because we're looking at them from a household perspective. But if they don't want to come onto the loan, I believe, Taylor, we just need to identify the client and then we just need to get income verification and assets and liabilities for the party that's not coming onto the loan at all. Just so we can verify their statement of position to make sure that they can cover their share of their debts.
Exactly, yeah. So we service them as a household and then we'll have our applicant servicing theoretically as a single and just servicing our debt. If both of those work and we've verified the partner's income, then we could go that way.
Wonderful. Okay. So we do have a fantastic policy in terms of employment, income and employment. So we have a 1-day enroll policy. So if you've got a client who is permanent, full-time or part-time, we can accept them 1 day in their new role. They can be on probation as well. And then there's no other time restraints or policies factored in there. A question that I did have for you, or a couple of questions that I have on this for you, Taylor, is with the 1-day enroll policy, do they need to have any prior industry experience in that for the new employment?
If they're under prime, they'll need to have industry experience in a similar role with no gap in their employment. But if we move to near prime clear, near prime and specialist, they can be just 1 day in a full-time or permanent role. And and they don't have to have that previous experience.
It's a brand new industry.
Yeah.
Yeah. That's amazing.
Yeah, and look,
That is so flexible. Particularly like I just think of all the mothers out there that have been on extended mat leave, for example, and they've not been with their employer and they want to get into something different. You know, they've had a change in heart in terms of what they want to do with the rest of their life, which happens a lot. You know, they've got that flexibility where they can get a loan just from one day enroll. A follow-up question to that one. What if the client, if they one day enroll and their employment contract stipulates that overtime is a requirement of their role? What's our stance on that in being able to include that additional income source?
yeah, I mean, you just highlighted it. If it's stipulated in the contract that it's part of their role as ongoing, then that's when we can look to take 100% of it. Depending on how reliant we are from their base to the overtime, we might do some background. Did they worked overtime previously? See what their previous role was like. Just comes down to how reliant we are on it. But if it's in their contract and part of their job and it makes sense for what they do, then we can look to take it as well.
Yeah, that's fantastic. So we can take overtime from one day enroll if it is stipulated as being a requirement of their role. Taylor, say for example, it's not in the employment contract, but the client can get a letter from the employer confirming the same. Will we also take it at that?
Can be considered. I mean, I would push that more to a case by case scenario. And again, you'd probably then want some history that they've worked overtime in their previous role. But if it makes sense, we'd need it demonstrated at least on their first pay slip. But things can be like that can be conditioned for. But yeah, we're pushing more to a case by case scenario.
That's okay. What I love is that it's not a no. And what I love is that we are always trying to say yes. So I think just, you know, a tip for brokers today on the call is put your own credit hat on. Would you lend the client money? Would you lend them your own money for what you're trying to get the credit assessor to approve? And if you can provide clear mitigation that mitigates the reason the policy is in place, and you would support it yourself, in those instances, absolutely send it up for an exception for us for a case-by-case assessment and do it before you lodge. There's no worse experience for the client and for yourself if you submit something that you know requires an exception and you don't talk to somebody before sending it, because the BDM or the RM, they can help you with those notes, help you with, you know, what kind of mitigation will support, what kind of supporting documents you'll need to get your best chance for an approval. And if you get that approved prior to submission, then it is a smooth process and seamless once that application is submitted, because it's already been given the tick of approval for that particular challenge. And then it is an easier process for you and the client. Now, I am going to rattle off quite a few different income types that we do consider for servicing. So we've got 100% allowance. So we'll take 100% of all of these income sources across our residential offering. It just depends on the product that is required. So you've got your full or part-time contract, casual or second job, overtime, commission and bonuses, self-employed, Centrelink pensions, superannuation. You've got housing allowance, interest and dividends, forms of guaranteed income, child support payments. We've also got options for unlimited ages for child support and Centrelink pensions, family A and B, fully maintained company car, car allowance, income protection, maternity leave, foreign income, like they're all at 100%, guys. The only ones that are at 80% is workers' compensation, and then your rental income is input at 100%, but it gets shaded to 80%. So there are so many different income types that are available there to support you and your clients there with really lifting up that borrowing capacity. Now we're going to run through a couple of scenarios here. So you've got Sebastian, and he wants to avoid going on a repayment plan with the ATO and to maximise cash flow. So Seb needs to pay out his tax debt of $150,000, and he wants to avoid going on a repayment plan with the ATO, as he would need to pay 11.36% interest. So Seb's business grew exponentially in the last financial year, which allowed him to invest back into the business to expand. However, he didn't think to put away any capital to cover his tax debt when he submitted his company tax return. Seb has equity in his owner-occupied property, and he would like to use this to pay out his tax debt. This would free up his cash flow to ensure he can maintain his company commitments. As Seb has no major credit impairments, he qualifies for the near prime clear option in our residential product offering. And this will allow him to pay out his total tax debt using his owner-occupied property as security. And to further minimise his repayments, we can also put him on a 40-year loan term. So a really good solution there for Seb. But what if real life happens, guys? So we do have, as I've mentioned a couple of times, the cascading credit model that allows you to assist clients that may be going through a life event or who have just gone through a life event. Now, this presentation pack will be shared with you after today. This is a fantastic table to refer back to clearly identify where your client may sit in that cascading credit model if they have been affected by a life event. Now, just note that policy is always changing. So yes, this is a great table. It does give you an understanding, but always just reference check with your BDM or your RM just to make sure policies are current. And also you could use our Pepper product selector tool, which also identifies where your client can sit in our cascading credit model for residential loans as well. Now, as you can see, the prime product here, very prime driven. The only thing that we look at considering here is personal purposes, and we can consider paid defaults up to $500, and they must be non-financial defaults as well, so your telcos and stuff like that. The near prime clear product caters for personal and business purposes, and we can look at assisting clients with non-mortgage arrears, so that might be credit cards, personal loans, car loans, and we can consider unlimited ones. So if you've got a high net worth individual who constantly struggles with managing their credit card, as long as they haven't exceeded the number 1 in the most recent 3 months on that non-mortgage debt, we can help them in that near prime clear product. And we can also consider clients who have unlimited defaults up to $1,000 each, whether they're paid or unpaid. Now, I'd just like to draw your attention to that prime and that near prime solution, and those are the products where we can assist with that 1% serviceability buffer. So as you can see, that near prime clear product does cater to the personal and business, and also factors in some credit impairment in that product as well. Plus, you've got unlimited debt consolidation across both of those products. Now, in that near prime product, we start to assist clients with a bit more serious life event, and typically a life event that's happened greater than 2 years ago that's somewhat major. So you've got late repayments on non-mortgages. Once again, we can consider them within the last 3 months period, as long as they don't exceed the number 3 on that liability within the last 3 months. We can do 1-day discharge from bankruptcy. We can do tax debt. We can do the private debts. In terms of defaults, we can have an unlimited amount of defaults up to $3,000 each. No time frames required for those. It could be lodged yesterday. And once again, we ignore them, so they don't need to be paid out. They can be left unpaid. If they are over $3,000, they need to be registered for greater than 24 months. Okay. If they've been registered for greater than 24 months and they are over $3,000, that tells us that the client is on the trajectory to get back to a prime position. They haven't had any other major life event occur within that most recent 2 years. So we can see that stability there. Now, in the Specialist and the Specialist Plus products, we can cater for defaults within the last 24 months, also within the last 12 months. We can look at mortgage arrears and all of that kind of stuff as well. So as you can see across the 5 products in that cascading credit model, we do have solutions to support any type of client in that residential offering. Now, capacity. So confirming capacity to repay is extremely important when you have got a client who has more than a 1 on their credit report for mortgage arrears. Now, we only consider the most recent 6 months of the repayment history information. So you guys have you can see the last 24 months repayment history information for all liabilities on comprehensive credit reporting now. We will only look at the most recent 6 months for major bank loans and the most recent 12 months for non-bank loans. Anything that happens outside of that, greater than 12 months ago or greater than 6 months ago, we ignore it. Even though we can see it, we ignore it in terms of product selection. Now, when you have got a client who has exceeded a 1 within that last 6 or 12 months for a mortgage, so they've had 1 month's mortgage arrears, if they've exceeded that 1, then you need to do something called a capacity test. Now, in terms of a capacity test, we require a capacity test completed and capacity needs to be confirmed. We also need serviceability done. So they also need to be able to service the debt. They need to confirm they have capacity to repay the debt. And we need to make sure both of these things are done and evident before you submit the loan. We have a lot of times where a loan has to get withdrawn or it's declined, where the client has got more than 1 month's mortgage arrears. And it's not a great experience for the client or the broker. And it's generally because capacity has been failed. So can you please, Taylor, talk us through what is a capacity test and why do we need it?
Yeah, so the concept is we want to see what they've been paying towards their debts that we're refinancing.
Mm-hmm.
Generally, this will be under our Specialist Plus to refi. They've got too many debts, they've become overwhelmed, and we want to refinance that down into the one debt, but we need to see this capacity where they've had mortgage arrears. So essentially, the last 3 months across each of the debts that we're refinancing, we want to see how much they've been able to pay. Doesn't matter if it's below the minimum, doesn't matter how much arrears they've actually got. We just want to see their recent history. Have they been able to pay at least what the new PEPA repayment is? So in this instance here, the last 3 months, we can see that the total they've paid across each of the debts is sort of 3,500, 3,200, 3,300.
Mm-hmm.
The new PEPA repayment is going to be $3,000 a month.
Mm-hmm.
We can see they've been able to demonstrate that over the last 3 months. We're putting them in a better position and we want to go forward. The reason that exists is while someone might pass serviceability on a calculator, or they earn 200 grand, but they've still got into a point where they've got this mortgage arrears, they might be terrible at managing their debts. They might be spend it all on exuberant things. They might be gambling, things like that. So while passing serviceability is good on paper, if they don't pay that towards their debts, then PEPA's going to refinance and just be stuck with the debt that they're not paying. So this is more about their behaviour and their willingness to pay. And that's what that capacity will show us over the recent 3 months. So we go, look, they're overcommitted, but they're wanting to pay it. And we can see that across all their debts. We're going to put them in a better spot.
Perfect. So to sum that up, we definitely want to provide solutions for clients that have mortgage arrears, but we want to make sure that we're not going to put them into further financial hardship once the debt comes to us. We want to put them in a better position, put them on a trajectory back to prime, and make sure that we're giving them better options for their finances and putting them to a better financial position. And it gives you guys a good opportunity as well to have that conversation around, PEPA has a solution for you right now to consolidate all those debts. They don't care about but they don't care about your mortgage arrears because you've shown that you are trying to repay them, and the new solution is going to put you in a better financial situation. If they've only got mortgage arrears, they're only going to sit here for 6 months or 12 months. Then they can go straight to prime if they've maintained those debts and they haven't accumulated any other adversities on their credit report. So you've got a solution for the client immediately, and then within 6 to 12 months' time of good repayment history, straight to the prime product. And then if they want to go to another lender after that, what have you, that's totally fine. But we're giving them those options in that succession plan and pathway back to prime lending relatively quickly as well. So really great outcome and options and solutions for your clients when they have mortgage arrears. Now, we won't go through this table in detail because you will have access to have a look at the type of life events, the description and the length of time that it sits on that credit report, but it is a really good, there are some great definitions here. We do get a lot of questions around, what is a default? How long does it sit on the credit report and so forth? So have a read through these, keep this up your sleeve. So when you are having those conversations with your clients, you can have them with confidence and you can have a robust conversation which presents a solution that can assist, because the biggest hurdle with clients who may be with a prime or a NAB or a CBA, and all of a sudden their finances have come unstuck, is that realization moment of, hey, I'm not a prime NAB client at the moment. Or I don't belong at a non-bank. I'm not that type of client. So it's around trying to get that client on board with acceptance mode. So having stuff like this up your sleeve will really allow you to have those confident conversations and get your client into acceptance mode, so you can get them into that solution that they need quickly and get them back on track. Now, we do have another scenario here, but I'll leave this for you to review it at a later time, because I do want to leave some time just to go through a few questions that we have in the chat. So Steve, I don't know if you want to drive this or you want me to just continue talking.
Yeah, I'll give you a 30-second break. You've been chatting away for 50 minutes, so I'm sure you need a breather. So some of the questions that have come in are centered around security types.
Mm-hmm.
So I'll reel them off one at a time, and if you could just give us a yes, no, maybe, or any parameters around maybe LVR and things like that.
Yep.
So the first one is centered around farming zone property that's non-income producing. Is that something you guys will accept as security?
Could be considered. Whilst it's not, don't want to put it as a blanket yes, but yeah, when there's no income, not income producing, subject to a full val confirming that, it can be considered. I just don't want to blanket yes it.
No, that's okay. The next one is NDIS investment properties. Will you guys support that type of application?
Under commercial.
Yeah, we do. So we've got low care options with higher LVRs, and then we've got high care options at lower LVRs. So yeah, absolutely, that sits in the commercial space. We don't have construction options available for NDIS, but we do absolutely assist with purchases and refis.
Amazing. And the next security type is student accommodation. Will you accept that as security?
Again, goes under commercial.
Yep.
Yeah, so your standard, in residential offering, we look at owner-occ and investments that are deemed residential properties. Everything else, all those different specialised security types, absolutely sit in that commercial space. We can do childcare, boarding houses, rooming houses, NDIS. There's a massive list of security types that we consider in that commercial space as well. So we can pop that. I can give you the link to that information, so we can include that in the post comms that go out to your members as well.
Amazing. Now, shifting across with to income verification, bonus payments. There was one thing that wasn't covered. Do you guys accept bonus for income, acceptable income?
So we have bonus and commission income that we accept. Can you talk us through this, the 2-year and a 1-year option?
Yeah, so if they're on the prime product, will be an average of their last 2 years bonus, so an average of the 2 years or the most recent year if it was lower. Whereas on the near prime clear and down, we can just do it off the most recent 12 months. And the same for commission is just what's received in the last recent 12 months.
And that's at 100%.
Yeah.
Beautiful. It's a beautiful thing. Next one, is there any liquidity conditions for SMSF lending, residential SMSF lending?
No, so we have no liquidity requirements. The only thing that we do have is we need a total asset balance made of cash equity or shares of 150,000. So that must be, but that can be utilised within the deposit even. So yeah, there's no liquid assets that need to be made available post-settlement.
Amazing. The last one there is just around commercial interest rates, which is I'm sure that's a very broad number, but where do they start from? Just as a starting point, kind of what's the top of the pops, best option, best rate available at the minute?
I don't even know.
Yeah,
I had to be honest.
Again, I'm more residential, so off the top of my head, I'm not going to know. Give me 30 seconds.
We can get it for you. Taylor can just jump on and have a look. I haven't looked at the rates myself for quite a while, so I couldn't tell you. Well, we'll have them available in 10 seconds, 20 seconds.
That's okay.
But yeah, look, if anybody, whilst Taylor's looking that up, if anybody has any further questions, they've had time to marinate on the content that's been delivered today, that I can, I can understand there's been a lot of information, a lot of policy that we've talked about today. So if you do have a scenario that jumps on your desk tomorrow that relates to something that we're talking about today, and you do have a question, by all means, you can absolutely reach out to myself directly. If you haven't put your hand up for the survey response, and then I can put you in touch with your BDM or your RM or answer the question directly for you if you do have something after today's session. Taylor's got the rates up here for us.
So prime full doc up to 60%, you're looking at 7.44 would be the
that's the
cream of the crop there.
That's the starting rate. But just on that, we have 30-year loan terms in commercial. We have the same rate for P&I or interest only. There is no GSA or fixed and floating charge taken over the business. We just take a mortgage over the security. There's no annual reviews done with us. There are so many niches that really support the product proposition in being favourable in comparison to other lenders, particularly with your major banks as well. And you have got those options around alternative documentation. And when you're looking at full doc, you have the financials option as well, where you don't need to lodge those tax returns. So lots of reasons that mitigate, if anybody's questioning the interest rate there's lots of reasons to mitigate that interest rate and it being a better solution.
Yeah, amazing. Look, I think that's still a pretty good rate. There's some, there's a solution, which is what's important. And, the sentiment out in the market, we hear it all the time. It always feels like banks and lenders are always trying to find a way out of a deal. And what I love about what you guys are doing is, and you touched on it earlier, is that you really want to say yes to every deal you see. And I love to hear that. And I'm sure everyone on the call today feel the same way. So well done to you guys. And you've obviously got so many options, and there's a suite of products just about for every scenario, which is fantastic. And I kind of do feel for you guys having to get to know it all and understand it all, but well done. You obviously know your stuff, which is amazing. So thank you so much for today. We do really appreciate it.
No problem at all. Our pleasure.
Thanks very much.
So we'll thank you again to you both for coming on today, and thank you to all our members that jumped on as well. We had a big list of people on there today, so thank you. Now, the survey that Samantha touched on will be sent around as well, so I do encourage you to complete that. It's obviously going to add benefit to yourselves as brokers, as well as your clients, understanding where you can best help them. Now, I just wanted to close off with one question that I had. Now, since this tax, the ATO change around, putting in arrangements and things like that, has there been a big uptake so far? Like, I know it's only a month or so since it's coming to effect, but are you guys seeing, deals coming in where people are using some of your offerings to use them for their customers?
Absolutely. I mean, there's probably been an uptick, but even the last 12 months, tax debt's been rife, and we've been doing lots of it as is.
We've had tax debt as a solution for quite a long time, and we started seeing an increase in flow with ATO Tax Debt when the ATO started placing the defaults on credit files, which was preventing individuals from getting new debt because the majors wouldn't take that. So we had a lot of influx of clients coming to refinance and pay out that debt to get that default removed. And then obviously the changes from the 1st of July has just reinforced the need to get that paid out more quickly. So yeah, we're definitely the home for ATO Tax Debt.
Amazing.
The ATO loves us.
The ATO absolutely loves us. We're helping them with their debt.
Excellent. Well, thank you all again. Thank you for everyone attending. The CPD code will be sent out, but it will probably pop up in 2 seconds as well. Now, thank you again. And for all our members, we really appreciate you jumping on today again. And as we all know, Wednesday webinars are a thing that we love, and we do it every week. So there will be another webinar coming up again next week. So stay tuned. We obviously send out a lot of socials and updates around what's on and what the things that we're doing in the market. So encourage everyone to jump onto that. And all our webinars are also saved on our learning center. So generally within 72 hours of obviously recording, which has just happened. So I encourage our members to share that across their networks as well, because it is obviously extremely valuable to get your head around, the offerings that are available in the market. So they are also on the Learning Centre. So do join in for those. So again, thank you heaps, guys. I really appreciate your time.
Thank you so much, Steve. Thank you.
Cheers.
See you later.
Bye.
Bye-bye.